Accounting for prepayment. What is prepayment? Often, customers make advance payments for expenses as well as goods and services to shed their financial burden. Any payment in advance can be considered a prepayment. Prepayment is a term used in accounting that refers to paying off an expense or debt obligation before the due date. Put simply, these are expenses paid for but not yet incurred. As an example, a company pays $12,000 on January 2, 2021 in advance for internet advertising that will extend through a full year. In this example, the expenses of the company in internet advertising for the full year paid as early as January 2, 2021, but eventually not yet incurred. Due to the nature of certain goods and services, prepayments will always exist. For example, insurance is a prepayment expense because the purpose of purchasing insurance is to buy proactive protection in case something unfortunate happens in the future. Clearly, no insurance company would sell insurance that covers an unfortunate event after the fact, so insurance expenses must be prepaid by businesses. As an example, if a company pays $12,000 for an insurance policy that covers the next 12 months, then it would record a current asset of $12,000 at the time of payment to represent this prepaid amount. In each month of the 12-month policy, the company would recognize an expense of $1,000 and draw down the prepaid asset by the same amount. Another is a prepaid rent, which refers a lease payment made for a future period. For example, an organization makes a cash payment to the leasing company, but the rent expense has not yet been incurred, so the company must record the prepaid rent. Prepaid rent is an asset because the prepaid amount can be used in the future to reduce rent expense when incurred. Examples of prepayment include loan repayment before the due date, prepaid bills, rent, salary, insurance premium, credit card bill, income tax, sales tax, line of credit, etc. Financial presentation and classification of prepayments. The balance sheet is an equal sign with company assets on one side, liabilities plus owner's equity on the other. It shows readers the value of assets less cash, real estate, equipment less, and how much the company would be worth after paying all debts. Are prepayments assets or liabilities? Prepayments are recorded as current assets under the account prepaid expense in the statement of financial position or balance sheet until it is consumed. Prepayments are considered current assets because they are amounts paid in advance by a business in exchange for goods or services to be delivered in the future. Prepayments usually relate to the purchase of something, such as rent or insurance, that provides value to the business over several accounting periods, often 6 months or a year. If a prepaid expense were likely to not be consumed within the normal operating cycle, it would instead be classified on the balance sheet as a long-term asset, a rarity. The business records a prepaid expense as an asset on the balance sheet because it represents a future benefit due to the business. Moreover, as the benefits of the prepaid expense are realized, it is recognized on the income statement. Prepaid expenses are not initially recorded on the income statement because, according to the generally accepted accounting principles, GAAP, matching principle, expenses cannot be recorded on the income statement before they incur. Once expenses incur, the prepaid asset account is reduced and an entry is made to the expense account on the income statement. In order to understand further the topics of accounting for prepayments, here are the following journal entries. 1. A prepayment transaction is recorded initially by debiting an asset account, such as prepaid insurance, prepaid rent, etc., and crediting cash. 2. At the end of each accounting period, an adjusting entry is passed that debits expense and credits prepaid asset for the part of goods or services which have been received in that period. Example, on April 1, 20x5, Company B pays $40,000 for 12-month rent in advance. Company B's financial year ends on June 30, 20x5. Required, 1. Journal entries to account for the above transaction on April 1, 20x5 and June 30, 20x5. 2. Balance in prepaid rent account on June 30, 20x5. Solution, on April 1, 20x5, to record the prepayment as a current asset, its prepaid rent is $40,000 and its cash is $40,000. On June 30, 20x5, to record rent expense for 3 months equals $40,000 times 3/12. Its rent expense is $10,000 and its prepaid rent is $10,000. Balance in prepaid subscriptions on June 30, 20x5, 40,000 less 10,000 equals 30,000. Recording of prepayments. Prepayments may initially be recorded using either expense method or asset method. Under expense method, prepayments of expenses are initially debited to an expense account. On the other hand, asset method initially debited prepayments of expenses to an asset account. For example, a business prepays 1 year for $12,000 on October 2, 2021. The entry to record the transaction under the expense method is to debit insurance expense and credit cash amounting to $12,000. Under the asset method, prepaid insurance is debited and cash amounting to $12,000 is credited. After the initial recording, there is a need for adjusting entries on the transactions. Journal entries that recognize expenses related to previously recorded prepaids are called adjusting entries. They do not record new business transactions, but simply adjust previously recorded transactions. They are made prior to the preparation of financial statements to update certain accounts so that they reflect correct balances as of the designated time. Adjusting entries for prepaid expenses are necessary to ensure that expenses are recognized in the period in which they are incurred. We go back to expense and asset method. Under expense method adjustment at the end of the period, the unused portion is recognized as asset while the incurred portion remains as expense. While asset method adjustment at the end of the period is that the incurred portion is recognized as expense while the unused portion remains as asset. On the given example earlier, adjusting entry is needed on December 31, 2021 to separate expired portion of the 1-year insurance which will be recognized as expense in asset method. The entry to record this is by debiting insurance expense and crediting prepaid insurance amounting to $3,000. Another is on unexpired portion which will be recognized as asset on expense method. The entry will be debit to prepaid insurance and credit to insurance expense amounting to $9,000. Additionally, prepayments initially recorded using the expense method may be reversed. Reversing entries are entries usually made on the first day of the accounting period to reverse certain adjusting entries in the immediately preceding period. It is done to facilitate recording of cash receipts and disbursements in the next accounting period. An amortization schedule that corresponds to the actual incurring of the prepaid expenses or the consumption schedule for the prepaid asset is also established. What is prepaid expense amortization? Prepaid expense amortization is the method of accounting for the consumption of a prepaid expense over time. This allocation is represented as a prepayment in a current account on the balance sheet of the company. With amortization, the amount of a common accrual, such as prepaid rent, is gradually reduced to zero, following what is known as an amortization schedule. The expense is then transferred to the profit and loss statement for the period during which the company uses up the accrual. What are the benefits of prepaid expenses? Prepayments help you to understand how much profit your business is making in any given month. For example, if you make a payment that covers several months, but you record it as a lump sum in the month when you made payment, it will affect your profit margins for that month. By spreading the cost of payment over several months, you'll gain a more accurate picture of how your business is performing, which will have an effect on the efficacy of your business's financial model. Furthermore, businesses prepay expenses because they can receive a discount for prepayment. Prepayments may also provide a benefit to a business by relieving the obligation of payment for future accounting periods. There may also be tax benefits concerning prepaid expenses, however, all organizations must follow the proper rules related to tax deductions.